Okay, so Assalamu alaikum to all of you, and today we are going to start our lecture 7, which is about financing and accounting. So financing and importing is the crucial, important things in the startups. So what we have noticed is most of the startups or entrepreneurs, they are just focused on the product. They are just trying to make the best of the products, and they just give a very little attention toward accounting and financial aspect. And because of not having the right accounting and financial planning, we have seen many startups, they get failed. So it is very crucial, important to safeguard your money and you to look for the resources from where you can get these money generated. So this is almost a continuation of our previous lecture. Here we'll be talking about some different dimensions of financial. So today's learning objectives are: number one, identify key financial issues that are involved with the starting a business. Number two, discuss the basics of funding a business. Number three, explain the importance of proper accounting when starting a business. So let's jump into the today's main topics. So we'll be discussing key financial issues involved with the starting a business. As I already explained to you, the funding and funding level of the firm is very crucial. And then establishment of an accounting system is crucial. Then for specific attention to flow of the information is important. So the businesses, they do not understand the funding nature and from where they will be able to source the funds for the company, and how would the cycle of the money will go on, and they just face failure despite having the best of the business ideas and despite having the best of the products. So we need to have a formal accounting system that should let us know how the cash flow, how the money, and everything has to be recorded. And then the flow of the information, especially from the accounting perspective, is very important. Okay, so basic funding a business. So how we get it? The funding starts with the founders and her own personal resources. So the first person who will be funding is you yourself as an entrepreneur, and firm may need other sources of funds. When you are short of funds, then you can go and explore other sources. Sources may be small and may not be tied to an ownership interest in return to the funding. So in previous lectures, if you remember, we talked about you can get funds from your friends and family, but you must be very lucky if you can get funds from them. These are non-informal sources. Then you can go and explore for some formal sources for funding as well. And let's see the terminologies that are being used for funding. One is equity investment. Apologies. What is equity? Any idea? Okay, so equity is basically we call it owner's equity. The share in the business, the pie of the business. Okay, so you have an ownership, say 100% of the business, and then you give away, say 20% of the business. That is, you are offering 20% of the equity. So that's what we call owner's equity. Initially, the entrepreneur invests 100% of its own owner's equity, and then they can sell off their equity. So fund received by a business in exchange of percentage of the ownership of the business is called equity investment. What is crowdfunding? It's a buzzword nowadays, and we see many crowdfunding. These are the funds received by a business by soliciting a large number of very small investors usually through internet. So they have the internet has provided this facility that many people, and not all of the people, they know how to do the businesses. So for them to make a good revenue and profit is to invest into some successful entrepreneurial setups. So these crowdfundings, they provide an opportunity for the investment. So there are lots of many small investors. They invest into those projects like your startup, and they take care of their profit margins from this investment. This is called crowdfunding. Okay. There are other sources which are non-equity, like you're not surrendering your share in the company. One is debt. Debt is also called loan that you might take from banks. So there's a formal procedure in which you can apply for the loans, and you have to develop and sign for the loans from the bank. Obviously, you'll have to pay the interest for the credit card is another source through which we can get a debt. There is like asset leasing companies from where you can get the loan, and individuals and suppliers, they can also provide you in the loan. Then there are certain grants. These are basically from the governments. There can be some private grants as well, but these are like, they are no loans. They are basically free grant that has been offered by the government mostly to help to the young entrepreneurs so that they become capable enough to run their businesses as such sustainable model. This is like in which winning for the business plan competitions, many entrepreneurs, the young entrepreneurs, they get grants. Here at Kingfisher University, we have CODE. If you register your business idea, you can get a grant for that. Okay, by the way, there is a competition. I would urge you guys to apply for that competition. I saw there was an invitation for I saw that Kingfisher University is offering an international grants. So I would advise you to please apply for that grant, and we need to get win this international grant. So with my supervision, you can apply for this grant and can get guidance from me if you like. Okay, so shall I share with you? Let me share with you. Let me share the, where is it? We'll have to translate it for you. This is the translation of the email. So I would like if you guys apply something in this. There's a form also available here. Okay. Do you want me to translate it for you? This is a great opportunity for you guys, so you can make this learning into practice, and then you can win up to 100,000 US dollars. Is it good? See here, I'm just sharing with you. I just translated it into English as well for you guys. So the lists. Let me move it back to the inbox. Okay. Okay, so I got it back. So I hope you will try to explore this and will share your whatever your ideas with me, so I can supervise you and together we can go and win $100,000. Okay, so moving on to the next slide, we'll be talking about the debt. Debt, again, I told you these are the loans, but again, these loans are not giving away your share in the company. So generic terms to describe the type of non-equity funding tied to the business. So we talked about equity. So we are not giving away, surrendering our share with the company to the people. They will be providing us the debt. So any form of capital infusion. Capital means money, or capital is a broad term, but we can call it here for money or flus for the sake of understanding. That must be paired back with an interest. So the only issue with the loan that you will be taking from, say, from the banks, from individual donors or credit card, that might be linked with the interest. And the loan that you will be taking from your friends and family, that might not be linked with interest. But having said this, the businesses have been given a great opportunity when they take the loan. You will learn it in income statement that this is when we take the interest, we get the sales and the profit. Then we have reached to, and we take all the cost, then we get EBITDA, EBIT, earning before interest and taxes. So we had some X amount of sales, then we get the cost of the sales out of it and all administrative charges, then we get the income, which is earning before interest and taxes. Now the government allows us to give away the interest first. So that's why most of the businesses, big businesses, they take lots of loans so that they get facility on interest. So they pay lots of interest and they get little amount before taxation left for the taxation. So they, no doubt this affects negatively for their profit, but because of the lots of loan, they, no doubt this affects negatively for their profit, but because of the lots of loan, they can develop their own big empire. So we will discuss these later on in detail, inshallah, as well. Okay, the loans, these are basically contractual agreements where the firm receives some amount of money that may be repaid over a specified period of time at a specified interest rate. So we normally get a loan from the banks, and there can be an option in which we can get asset-based lending loan provided for the purchase of a necessary asset of the business. So sometimes you buy the land, or sometimes you get it for plant and machinery. Family and friends are other sources, as we discussed, but there you don't have to pay no tax. Founders may choose to loan the business, so you yourself can also provide a loan, or other founders can also give a loan to the business, which they will draw later on. Credit card is again a different kind of a loan facility that is provided to us. Card entitles one to revolving credit. So once you pay the you take the loan for, like, say 30 days you'll get no interest. So when you pay off within 30 days, you can get the same limit again, and you can just borrow again. So this gives us a revolving credit, but does not have a set repayment schedule. So where you have the fixed facility for at least 1 month, you don't need to pay back. It has a set upper limit. So every credit card has a limit. So for example, someone has got a 35,000 real of credit card limit. So he or she will be at the most they can get this much credit, tied to a much higher interest rate than the bank loans. So they tend to be much higher interest rates. So obviously, if there's a default chance you cannot pay it on time, then you'll have to pay a huge interest rate. Okay, so what are the risks and rewards of using credit cards when financing a business? As we just talk of, like there's like 30 days credit, and for some reason you are not able to pay it back on time, so you'll be paying high interest rates. Yes, and the advantage that we have is like once you make the payments or you borrow from someone, pay the credit card, then you are again eligible for this amount. So advantages and disadvantages are always there. Suppliers, from where you buy the raw materials, they can also provide you assistance. They can help you in physical assets like refrigerators or molding equipment, and they can provide you actual supplies which can be provided on a loan. So they might extend the period for payments from the supplies that you have bought from them. Normally, as I might have told you, there is a term that we call it 210 and 30. This was the term that was used by the supplier. So basically, when we get supplies from the supplier, they provide us 2% discount if we pay it within 10 days. Obviously, they know like people will not try to pay it within time because you will like to extend an amount, and they provide like 30 days of time to pay the whole amount. So this suits them, but on the other hand, their money is stuck with us and many other suppliers or wholesalers for the 30 days. So that's why they would like to have push us as a business to pay it within 10 days, and we can get this 2% discount. Okay, so grants, as we talk about, these are the special funds that do not require repayments and are designed to avoid the businesses in specific area. So new businesses should explore both government and private funding as grants. So mostly we have seen like the government grants, they are free. Like I have just shared with you, there's $100,000 of prize. This is the competition. If you enter into this competition, you can win this inshallah. Okay, the equity funding. This is if you are watching, Dragon's Den or Convert. What's the other name? Shark. Okay. So in that you'll see people go over there. They pitch their startup and then they ask for the equity funding. So equity funding is like when you're giving away your shares in the business. Evaluation is needed to determine the percentage of the ownership each founder will have in the business and the percentage that they will be reserved for investors. So if you watch Shark Tank, you'll see like the people are very critical when you don't make your equity funding realistic. So they just don't like it. So it has to be a proper evaluation. You should have a realistic picture or value of your business. So they will not buy anything superficial kind of value for the business. So investors can be active or passive. Like if you're watching Shark Tank, you will see the active. Sometimes they offer you active investment in which they will be on all this stuff, helping you out. And they can be like just passive investors and they will just sit back and this is your responsibility to make sure that the business is profitable. They can go with the majority or minority shares. If you are very desperate, you will sell the majority of shares, otherwise you will stay minority to the companies or suppliers. So this is done in consultation and this should be done to the companies or suppliers. So this is done in consultation and this should be done in consultation with the attorney, because if you do not understand the real value, then you will be selling your shares for peanuts. let me check how much KFC was taken initially by the shareholders, because Sandler just sell it mm, before. So how much Sandler sold it, and how much later on the company KFC made the profit out of it is a huge, humongous difference. So basically, we know that Colonial Sandler started KFC in 1930 during the Great Depression, selling fried chickens from his roadside restaurant in Kentucky. By the 1960s, he had to build a popular franchise. So in 1964, at 73, Sandler sold this. Okay, so he sold it for $2 million. And later, KFC has earned huge profits. So see, like Sandler sold KFC for $2 million. The brand later grew into multi-billion-dollar global enterprise. So that's why we have to understand the importance, and we can think like how much profit or loss we're going to make. Okay, so other sources are like other funds, venture capitalists, and business angels. We look them into separately. Okay, let's have like businesses as equity investors. So large firms like Microsoft, Intel, Cisco have traditionally been among the most active equity investors in new startup firms in technology sectors. So what are the pros and cons of equity investment from an established firm? Students, would you like to share your thoughts on it? If a well-established firm like Microsoft, Intel, or Cisco is offering you an investment into a share, what is the benefit? What is the loss that you might anticipate? Is it good? Is it bad? Mhm. So let me tell you what are we looking. So why these big established companies are looking to buy. So they have least expensive means for new ideas and products and methods. So they can get ideas from young brains like you, and they'll be developing ideas in-house, will distract the firm from the core business. So they don't want to do it themselves. They will encourage you, appreciate you, and they will get this through investment into startups. And the third thing is successful startups are purchased. So there are chances that they will just purchase all the shares and brought into the core organization. So this is less expensive. They can see the individual's capacity and the passion, and they just help them to develop those ideas into practical things, and then it is a win-win situation for both of them. Similarly, suppliers, they can just make simple investment, they might restrict you like the type of equipment investments. Like they can give you a deal involves and or the contract that you do with the supplier. They might ask you to have exclusive agreement that you'll be selling their products or you'll be buying their product and you'll not go to other suppliers. So that is kind of they'll be restricting you. And the second thing can be founders should be careful not to be losing flexibility needed in the future. So if you go into a contract, say for 10 years, initially with the supplier, say X, and then you see there's a Y supplier, they provide much higher quality products and less expensive. So this will hamper your overall profitability of the future. And then if your competitors are buying it from supplier Y, this means they are able to manufacture those products and services more economical than your production, so the cost of production is less. So obviously it's going to affect your compatibility in the market. So this has to be looking from a very serious perspective. Okay, who are venture capitalists? These are basically funds that are that is organized to make a significant equity investment in a high growth new ventures. So this is limited partners may be included wealthy individuals, they can be VC, or insurance companies can be in these, or other companies or retirement funds. They can try to be your venture capitalist. Business angels, contrary to venture capitalists, they are high net worth individuals. So these are individuals, who invest in the business not as a business but as an individual. So their investment is not as part of an business. They are just there to help you, support you, and just try to take their profit from your business. New business persons should seek those with relevant knowledge to add to their firm. So ideally, you should take business ventures, business angels, the individuals who have got previous knowledge and they can help you and grow. Crowdfunding, as we previously discussed, they are like on internet. We provide lots of small donors. We can gather them. So it is a mean for raising capital. In internet, there are many capitals like Kickstarters, GoFundMe, and the Indiegogo. And similarly, in Kingdom, we have some Tamimi, or there was a form, Tamheed, Tamwed, Tamheed. They are also crowdfunding. Tamwed. This is also, I think, a reliable crowdfunding source platform. Okay, what are the other financial tools that we should be looking for? This is asset leasing. This is an option that you have. You can develop a form of lease tied to a particular asset used by the business to convert cash and maintain the latest version of whether the equipment is available. So you can lease your one of the plant and you can get the latest equipment, or you can get some cash, whatever you want to take. So, but what you agree is to pay back, and like you're buying this equipment on a lease. That means you are paying over a period of time to get this. So that can be a very beneficial way. Obviously, you are paying something higher than the current price, but since you are paying in small installments, so it's good. Similarly, accounts receivables we call factoring. So factoring is account receivable. Account receivable means you have, say, sold your product, and your customer has told you that they will pay you after 30 days, as I told you at 210 and 30 in the previous slide. Let's take this example, 210 and 30. Like they will pay us the full amount after 30 days. So imagine we have sold some 2 million, or we are to receive 2 million at the end of the, say, December. Does it November? Okay, at the end of the November. Now we can sell this 2 million account receivable on a discounted price, means less price. So somebody is willing to pay us 1.8 account receivable on a discounted price, means less price. So somebody is willing to pay us 1.8 billion cash, and they say like when they will pay us, they will get 2 million. So this cash in hand today is better than tomorrow. So that's how we sold it at a discounted price to another company to receive the immediate cash. This process is called factoring. Okay, so we also have an option that is called private equity. Private equity funds basically are the series of funds intended to provide capital to investment in existing business that the investors believe can be leveraged their resources to improve the entrepreneurial venture. So these are the private firms. They are private equity funds. Their objective is to invest into a small entrepreneurial setup. But private equity firms work to professionalize the operations of the business. This is an advantage. They can help you to professionalize your business working with the aim to ultimately sell the business to a larger organization. But what they will do, they will develop your systems and then they will be willing to sell your business to some big companies. They are expert in this field. So the advantage is that you are in safe hands. They see your business as a potential. They see like if they can help you to organize business setups so your business can be of a great value, and then they can help you to sell the business, or probably they can sell their own shares. Okay, so initial funding, we you have to understand the sources and how we can create the initial funding. To calculate the maximum amount of outside funding that we will be needing, the new business person must multiply the lower ending cash balance on the cash flow statement with 150%. Okay, so if you have 10,000 cash with you, or then you can multiply it 1.5, 10 into 1.5, 150% means multiplying by 1.5, yes. So it will make 15K. So at least you should have this. Resulting amount is recommended for initial equity and equity plus debt. This amount is connected with the percentage of the fund that was previously determined would be made available in other investors. So let's see this example. Imagine we have a value of the firm at the start of the business operation that was $100,000. So the lowest point in projected we have achieved like 20,000 of the cash. Now, if we multiply this 20,000 into 1.5, we talk about 15%, 150%. That will give us 30,000 of the investment that is required. So initial investment that was done by you was 10,000. So what is required? It is 20%. So 20% of 100,000 will make it 20%. Okay, 20,000 of this. So we are basically willing to surrender 20%, or we will need 20,000 cash to make our business viable and running again. Okay, so what's the importance of proper accounting when starting a business? As I told you, most of the time the entrepreneurs are mostly busy on the products and the services, and they forget this accounting, which is the lifeblood for the businesses. So most entrepreneurs can meet their accounting needs with the available softwares. So there are many softwares that are available in the market. They can utilize them. Entrepreneur must determine if they will use cash or accrual basis accounting system. And they should also have some of the key reports that new businesses should be prepared to generate. Like they should make charts of account. They should know petty cash register. Petty cash is nowadays, even though everything is computerized, still you have to pay some cash. So you must have some cash handy with you. This is called petty cash. So like when you go on, if you're not going on Uber in Korean, you might need to pay the cash. Then you must need to have the check register, expense accounts, inventory accounts, accounts payable, and payrolls. These are the accounts that you must maintain or you should learn to maintain. There they have given us an example of profit and loss statement in which they have shown that dollars income in dollar is total income in dollar is 93,060. This account number 120 they earn like 1,084. Account number 140 110 and 160. Okay, this 1,340. Account number 200 they get this. From account number 201 they get 14,370. So all together the expense is 68,530 and total profit is 24,530 if we subtract all these accounts from the total income. Okay, so this gives us an idea of, I called you, this is EBITDA. If you remember my previous workings, this was earning before interest and taxes. That's how the profit and loss statement works. Over there we deduct the interest, say 4,000 was our interest, and then it will become EBT. The figure that we are going to get is earning before taxes. Okay, so it's going to be that we are going to get is earning before taxes. Okay, so it's going to be 20,530. And from that we will take the government tax, say 500, and then we can get the profit. Okay, so coming to the lessons from the famous entrepreneur, today we will again discuss Steve Jobs, who was the chairman and co-founder of Apple Insurance, which is now worth over $200 trillion and is also considered as one of the big four technologies along with Amazon, Google, and Facebook. So according to Steve Jobs, he says your time is limited, so don't waste it living someone else's life. So if there is one lesson that we need to learn it from Steve Jobs is put a dent in the universe. Like when you are alive, you should make some efforts and make some change for betterment in the world. Okay, so some questions for you to have thoughtful or food for thought for you. And I hope you will be able to understand these by now. How can using loan help a new business grow? Explain the best use of credit cards in new business operations. Why should a new business person be wary of equity investment by the other companies? So we should why they should think which source is an ideal for them to get the loans or equity investments. Okay, that's it. This is the Balfour and Bruton 2022 entrepreneurship book that we are following. And this is it for today's lecture. If you have any questions, you are welcome to please ask me, text me, share your feedback. Is everything clear to us?